Hi, everybody. Jim Kruzan here, and welcome to the second quarter capital market review. This is information that'll bring you up to date through June 30th of this year. And as we do every quarter, we try to come up with a theme that will encapsulate what we just experienced. I was trying for a song lyric, but I really couldn't find what I was exactly looking for. But the song title is right on, and that is Slingshot by Jeff Beck. It appeared in his Guitar Shop album of 1989. And that's exactly what we saw in the second quarter, a huge slingshot or big recovery in the market for no reason other than effectively the can got kicked down the road. And we'll see that both in terms of data as well as a graphics as well. So why do we do these capital market reviews? We do them because we're trying to answer kind of where we think things are going and kind of where we are right now. The economy matters. Federal Reserve matters. At the end of the day, the market is somewhat noise, but it is grounded by the economy. At the end, the economy wins, and that's how we get recessions or expansions that are meaningful. And generally, the market will run counter to the data for a very long period of time. So for those folks who are retired, those where we have an existing amount of funds and we're not adding any additional dollars to those, downside risk protection, especially when the data turns ugly, makes, in our opinion, the most sense. So we're trying to get two things right. Understand where we are in the economic cycle. The bad news is these cycles can be extended and stretched for very long periods of time. So we might be a bit early. And where is the Fed? Are they tightening or loosening? And they've got a number of different things they can do, a number of facilities in terms of releasing money to the bank. They can play around with interest rates as well. So today we're going to dig into some of this. The agenda is relatively short. We're going to talk a bit about the economy, some macro data, big picture stuff. And then we'll get into the weeds a bit on exactly what sectors did what for the quarter and for the year and what that all looks like. I've been saying now for a better part of 2 years, the data suggests one of two things will happen. Either the data continues to weaken and we'll see a drop, which is the result of a recession, or we get the soft landing, which would show that the data begins to improve. And a lot of the micro data will start to show that it's bottomed out and progressively getting better. Either way, because this market has been kind of co-opted by the Magnificent Seven, those big, huge tech stocks that are AI affiliate, we were hoping to see a bit of a broadening out where other areas of the market start to gain some strength, where all the returns are not directly related in one way, shape, or form to Meg 7. We may begin seeing a little bit of that, and I'll show you that in just a moment. So let's get into this, and let's start with some of the big macro data. You've seen this chart a number of times before. This one goes back the last 25 years. I had been using a chart that goes back nearly 70 years. This is the leading economic index, or LEI. It's an index that's comprised of 10 key economic indicators. Together, it makes up the index. The index has been highly predictive of recessions. They've never missed, always called a recession. The problem is they're not very good at pinpointing exactly when it happens. But we've seen in the last 25 years, 3 recessions, which are these gray vertical bars, the one in 01, the financial crisis, and then the itty bitty recession we had in and out during COVID. The first recession was about a 52% drop in the market, came as a huge surprise. Data markets continued to rally as data continued to get bad until things just swooned. The exact same thing happened in the financial crisis. That was a 56, 57% drop in the market. In fact, the collateralized mortgage obligations, the mortgages that really caused a lot of the big problem, started to default and get really ugly as early as beginning of '07. And the market continued to go higher and higher until late fall in '08. And then we had that little blip of a recession called COVID, where the market dropped 38%. And we were out of it before we even realized we were in it. That's big data. That's like looking at an iceberg just floating around in the water. It moves pretty slowly. There's other data that's updated more frequently that changes as frequently as weekly, every couple of weeks, monthly, quarterly, and so on. We talked a bit about the leading economic index. The Consumer Confidence Index, reported by the same board that handles the LEI, also fell in June from May. It got weaker still. Now, this is June. This is not April or March with all the angst of tariffs. This is well after that. And it's effectively getting weaker. Consumers are getting somewhat concerned. Credit card delinquencies, well, those are now 12.3%. We're going to have to wait till next month to get the next quarterly update, but that was up from 11.3 and up from single digits a year ago. These are default rates, delinquencies beyond 90 days. People who have missed payments now for 90 days in a row. That's a significant number, a very large percentage. Not what you'd want to see, and it's progressively getting worse and not better. A data point that just came out this morning that I added to the slide deck was consumer credit card use. Really interesting. It is now a little over 5 billion. It was expected to be down from 17.9 billion the month before, but it was expected to be 10, and it was half of that. When consumers stop using credit, they start to get cautious. And you start seeing that in retail sales. You see that in goods and services, and we'll see why that's important. It might also be because credit card availability is becoming limited as well for the reasons we just mentioned. Mortgages, specifically those on commercial properties, office buildings, continue to rise as well. This was just updated at the end of June, and the delinquency rate is now 11.08, up from 11.01. It was single digits just a year ago. This is a big problem. There's something like nearly $2 trillion of these mortgages that mature in the next year and a half. And the problem is twofold. One, interest rates are a lot higher than they were 5 years ago. Remember, the government didn't start raising rates until 2022. Most of these mortgages are 5-year terms. So 5 years ago, it would have been 2020, and the rates were effectively 0%. So a mortgage was 3%. Today, they're 8 to 11. But the big problem is these office buildings that were used as collateral for the loans are now worth a whole lot less because they have less tenants and they have less revenue. And in many cases, they can't even come to close. So that becomes a big, big issue. Manufacturing has been kind of hit in a recession for a while now. When you look at a lot of the ISM numbers, the manufacturing numbers throughout the country, they are also getting weaker, not necessarily getting better. If you look at the second or third, I should say, from the top, manufacturing new orders fell again in May. The Philly Fed was unchanged at -4 in June. Anything less than 0 is contraction. The Chicago Business Barometer fell again. This is now 19 consecutive months. New York State, Empire State Index fell 7 points in June. This was just reported recently. Anything below 0 is weakening conditions. The real estate market, we're seeing backup now in inventories. And not everywhere. I couldn't tell you whether my house is worth more today than it was a year ago or not. But in areas like Florida, in Texas, in Arizona, and even Las Vegas, we're seeing prices dropping somewhat consistently. And we're seeing inventory start to rise. So as inventories start to rise, you start seeing situations where people will cut the price quickly. They want to be the first in their community to cut. And that has a real effect on consumer confidence as well. Inflation numbers are trending down a bit, which is good. But the concern is that they have a potential to uptick. We saw both the PPI and the core PPI, or I should say PPI and the CPI, both uptick a bit over the course of the last 30 days. Some of this is concern over or front-running tariff issues, and we'll talk about that in a second. And GDP for the first quarter was negative. We have not seen what the second quarter will look like. That will probably come out within the next month. It probably will be less than it was in December. Don't know where it'll be relative to the first quarter, but certainly we have seen a slowdown in GDP consistently now for the last several quarters. More on that later. If we're looking for an area that you can claim a bright spot, it might be the employment situation, just because it's somewhat nebulous and it's awfully confusing. You have the ADP, which reported a drop of 33,000 jobs in June. That was way, way less than we saw before. And the May numbers were then revised even further down. Now, this is a payroll survey. These are literally honest to goodness human beings either losing their job or getting added to a new employer in a new ADP payroll system. The unemployment rate actually dropped after the U.S. employment number came out, which is an extrapolation of Department of Labor data. They use an algorithm that's based on births and deaths, and then they expand that out. They've reported surprisingly a huge number of new jobs. Now, looking at that a bit closer, a lot of that was government, more than half, I think, and most of it was local and state government. And a lot of that was assumed to be because of year end and school districts hiring new people and whatnot. We'll see if that continues or not. But if you're looking to find some data point that can be somewhat positive, it has been employment to date. But again, those numbers are really prone to a lot of revisements. If we look at the economy, it's slowing. The chart, which shows kind of a basic trend line of about 2% a year. We were a bit above that in 22, 23, 24. Certainly, that's now trending back down toward base. And you can see that the year over year GDP numbers have gone from about 3% annually to down to about 2% annually today. Or the quarterly numbers have gone from second quarter to third to fourth, from 3, 3.1, 2.4, minus 5. But the real takeaway on this, in terms of where we're positioned in the near term for future, is the right-hand side of this, which talks about the components of GDP. And here you'll see that nearly 70% of our economy is consumption. And a lot of that is consumer-based. About 2/3 of the economy is consumer spending. And as the consumer goes, so goes the economy. And when you're seeing an increase in default rates, when you're seeing a huge reduction in credit card spend, that's a big, big issue. When you look at our federal finances, we spend a ton of money every year, but we don't really take in anywhere near what we'd like to. We take in approximately, well, let's just say about 70% of what we need. We have a deficit of nearly 30%. And that gets plugged by us borrowing money, and we borrow money by issuing new bonds. If you look on the right-hand side, the first graph up at the top, it shows kind of the expectation of what these deficits are going to look like over the course of the next several years on the passing of the Senate version of the bigger, better bill. That is now law. It was signed in over the weekend. and it was more in line with the Senate's version than the House version. But it shows an escalation of deficit. Another thing I want to point out is kind of where we sat at the end of the year. Federal net debt was nearly 100% of GDP, 97.8. That's not the true number. That's a net number. So that's total debt minus whatever the government owes itself, other departments. For example, it owes Social Security. It owes other entities within the government. And they also net out against that any assets that the government have. So if the Treasury is sitting on $1 billion or $500 million or $500 billion, whatever the case is, they net that out. If you want to know the true amount of money that the government owes, it owes people, it's going to have to write checks to clear those balances. You can see that on the left-hand side. It's right now about 120, 121% of GDP. That's a big, huge number. You'll see where we are with other countries, but we're comparing ourselves to Italy and Greece, which notoriously has had issues. Even Spain has 20% less debt than we do relative to GDP. And that's an issue because not only can one argue that market valuations might be a bit stretched, there's a lot of data on that, but the whole economy is somewhat in this inflated environment as well. As an example, if we go back and we look at that net debt chart, that's the right-hand side, bottom of the page, and you'll see where it's showing today nearly 100% or so of debt. You'll see that right here. Look at where we were in, let's call it 2000, dot-com bubble. We were sitting with about 30% debt to GDP. Today, it's 100%. So not only are valuations today somewhat reminiscent of where we were 25 years ago during the dot-com bubble, when market values continued to go up, data continued to go down until there was a major adjustment. Today, the whole environment is effectively 3 times as levered as it was then. So that becomes a bit of an issue, certainly something to consider as well. So let's talk about these valuations. This is the S&P valuation currently. By the way, this is forward-looking return assumptions. That's forward-looking P's, meaning taking current price and divide that by future-looking earnings. At the beginning of the year, the expectation was earnings growth would be 14%. On a quarterly basis, it's running closer to 5% per annum. Big dislocation. But that forward-looking PE is based on those same numbers. The point to this is those valuations are getting really stretched. And when you look at valuation based on kind of norm or average, they're also somewhat stretched. Forward PE 22 versus 17. Cyclically adjusted PE, or the Shiller PE, 37, almost 38 versus 28. Dividend yield is 1.6 versus 2. And earnings yield or earnings spread is now a minus number, meaning that you get a better return buying a BAA or investment grade bond than you can on the earnings yield that you're paying. That is the earnings you're getting, the yield you're getting on earnings based on the price you pay for the stock. Somewhat stretched. Doesn't mean it can't go higher, but at some point, these things fall back down to earth a bit. So we talked about this huge V-shaped recovery that we've had, this slingshot that we're talking about, which is right here. By the beginning of April of this year, beginning of this last quarter, the S&P had seen a 20% drop since February and was already down 15% on the year. And then the only thing that happened, did the data improve? Did all of a sudden the economy get better? No. The only thing that happened was the tariff talk got punted for 90 days. which, by the way, the 90-day period, I believe, is up actually today. And now it's been reset to August 1st, apparently that's firm, unless it's not firm. So we don't know what that looks like. But on that alone, the market recovered. And it was a risk on trade based on the assumption that Trump will always chicken out, that it's not going to be anywhere near as bad as he suggests. He talks tough and then negotiates light. And that's what the market believes is going to happen. The problem that we have with that is that's not what we've seen so far. This is a chart of tariffs, and you can see the last several years, tariffs have only represented about 2 to 3% of our total import consumption cost. And the red line, and by the way, that goes back decades. To see anything close to what we're expecting today, you'd have to go back, 100 plus years. Now that's based on the Liberation Day numbers that Trump came out with. That's the red line that you see here. That was the peak, 30% on average. And the market had a huge hissy fit, again, selling off significantly over a relatively short period of time. And then the big punt. And the thought was it's going to be something less than that. He put in a temporary 10% tariff. 10% is right here. And the expectation is the average tariff might come in at something closer to 15%. That's still not reflected in stock market pricing, but that's kind of where the expectations are in terms of tariffs. The reality is a little bit different. Just recently, we did come up with a tariff on Vietnam. That was, I believe, 20 or 25%. Korea and Japan is also, I think, 25%. That's quite a bit more than 15. It's a bit closer to 30. So what does that actually mean? And make no mistake, tariff is a tax. It's either that cost is getting internalized by the corporation, which restricts their margins and reduces their earnings, or get passed on to consumers who ultimately will buy less. Either way, it has an effect. And really none of that is being reflected in stock market values. So what about the slingshot? Well, it's been quite significant. In the second quarter, the S&P was up 10%. That's just since April. The NASDAQ was up 17. Again, risk on, the more speculative stocks perform better. The S&P, though, by the way, is up about 5% on the year. That's after a 10% move in the second quarter. Things of note, the international markets were up 10, now currently up 15 to 20%. The dollar fell 7%. It is now down almost 11% on the year. We'll talk about that in a second. And as a result, you've got a rise in gold, up 24% on the year as a result of the weakness in the dollar. And that certainly is having an effect as well on the international securities as well. One more thing. The returns, though, you see are less concentrated, meaning there are other areas of the market equally weight, now up 4, NASDAQ up 8, large cap value up 4.5. Now the return on a balanced fund is a lot less than that, generally because you are not getting nearly those same returns coming out of bonds. So the 60-40 portfolio, 60% stock, 40% bonds, on an equal weight S&P, well, for June, it was up 2. For the quarter is up 2, and it's up about 3 or so year to date. Not much headway, but we are beginning to see a broaden out. It's not a one-man show. It's not all Mag 7. But we're still dealing with a very concentrated market. Currently, if you were to look at the top 10 stocks in the S&P, those that have the largest market cap weighting, and that would be this dark black line that you see, you'll notice that right now, those top 10 names represent nearly 40% of the S&P 500. Those 10 names out of 500 are pulling almost half the return off the market. The Mag 7 alone is well in excess of 30%. That's a highly, highly concentrated market. If you go back to the dot-com bubble, an area of time where you could say, my goodness, look at how much of a bubble that was. The top 10, or I should say the top 10 names going into 2000 represented about 22% of the S&P, not nearly 40. So by those standards, this multiple is not quite, but almost 2x what it was back then. Gives you a sense for how much leverage there is or how inflated this is. To say nothing of, remember the chart talking about our debt level relative to the economy. Also a bit inflated, also a reason to maintain some degree of caution. This is the Mag 7, those stocks, Microsoft, Apple, Google, Amazon, NVIDIA, Meta, Tesla, through the end of the year. You'll see the first three columns, what they did individually in June, in the second quarter of the year, and for the first half of the year. And you'll also see for the first half of the year, there are still some negative numbers. Apple was still down through June 30th, 15%. Google was down 7%. Amazon was flat. Tesla was down 16%. And then others like NVIDIA, Meta were up quite a bit. The fourth column is interesting because that's the allocation weighting. So what percentage of the S&P does Microsoft contribute? What percentage does NVIDIA contribute? And so on. And then I did the same thing in the last three columns, weighted return for June, for the quarter, and for the year, taking into consideration their unique, those 7, their unique contribution to the S&P. So the weighted return in June alone, those 7 names represented over 2% of the S&P's return, represented over 7% for the second quarter, and only 1.5% for the first half of the year. Those were down quite a bit. Some are still down. But the big slingshot, which occurred in the quarter, you'll see that these magnificent 7 contributed over 70% of that return by weighting alone. So again, on the upside, in times of speculation, these things have really had a huge impact on performance. And X those companies, the returns would have been far more muted. And maybe you can see a little bit of that by going back and looking at the return of the S&P for the quarter versus the return of the equally weight, same stocks, just with the concentrations being equally distributed. The difference, more than likely, the Mag 7. So this concentration has caused this anomaly where valuations are really quite stretched. We talked about how the debt levels are quite stretched from where they were in 2000. And now we're talking about valuations being stretched relative to where they are historically. This chart just shows how this Buffett indicator is calculated. Total US stock market value divided by GDP. Really pretty simple. There's a bit of a lag because GDP is usually updated quarterly, and they don't usually release the numbers the day after the end of the quarter. It takes almost a month, so we don't know what that adjustment will look like. But this is through March, and this is clean data after the adjustment. We're at 200%, or the stock market is actually 2x that of our whole economy. That's really pretty stretched. For those who I've had individual reviews with using some of this data, I would explain that the top number, total stock market value, is all publicly traded stocks, large, mid, small, growth, value, tech, utilities, doesn't matter. And the only input is what one is willing to pay. And sometimes it's FOMO, sometimes it's fear, sometimes it's greed. But the market is kind of a emotional voting booth. And that's the value that one would place on the market at that point. One input. The denominator, which is GDP, has multiple inputs. The US government contributes to GDP. They pay salaries and buy real estate and buy cars and trucks and those kinds of things and missiles and all kinds of stuff. Publicly traded companies contribute to GDP, but also to a larger degree, non-public private entities. Think of all the people employed at University of Michigan, or better yet, University of Michigan hospitals. You can't buy stock in University of Michigan hospitals, but they contribute billions of dollars a year to GDP. So when the market is twice GDP, that's really stretched because they're only contributing a small fraction of total productivity of the market. If we actually took a look at where it is at the end of June, based on some extrapolation, it will probably come in at something close to 206, 207, certainly higher than it was in March. The values are getting stretched out again. And just to give you an idea, this is, again, based on March data. The numbers would be a bit higher as of June. We're at that point now where we're, again, 2 standard deviations removed from trend, really pretty stretched out. And whenever you get this stretched out of valuation because of some bubble within a certain sector, eventually the air gets let out, valuations come down. And since this is a chart, this blue line is graphically illustrating that ratio of stock value to GDP, it goes to reason that if you see a big drop there, it's because stock market values are dropping much more quickly than the economy is dropping. Because remember, if the denominator, the economy, gets smaller, as in a recession, the number should get larger, not smaller. So this coincides with big drops. We saw a big drop in the market from the late 60s into the early to mid 70s. We saw a huge drop in 2000. We saw another big drop in 2022 of 38%. And we never got stretched valuations going into the financial crisis. Imagine if we did. And that was a 58% drop. In closing, I want to bring up this one point. The dollar seems to be getting weaker. Now, some of that could be our debt levels. Some of that certainly could be tariffs. Whenever the dollar is cheaper relative to foreign currencies, it makes our goods and services cheaper overseas. And maybe that will help somewhat with tariffs. It also makes foreign goods more expensive here. But the US dollar has an effect on a number of things. And one of those is international securities. When the dollar weakens, international securities tend to perform. And you kind of see that here when we look at the year-to-date performance numbers of US, that's dividend included through June, compared to in US dollar denomination, what the international markets are doing. Up 18, up 19, up 20. That's versus 6. They're up in their local currency as well. They're outperforming the US on a relative basis. But adding the kicker of the currency deflation, it improves the returns quite a bit. And that's exactly what we've been seeing here since the beginning of the year. That's also one of the reasons in a number of our portfolios, we now have a fairly significant amount of international and have had that for several months now, compared to where we were, let's say, a year ago. And one last point about this is there tends to be periods of time when we see those changes. The gray bars here are not recessions, but periods of time when the dollar declines. And when you see this purple mountain above the trend line, those are periods of time when international securities outperform the US. And they can do that for an extended period here from 2002 through 2008. Here lately, for better part of 10 plus years, maybe that's because of a zero interest rate policy. Maybe that's because of the huge increase in corporate or in government debt. But internationals have underperformed. And now we're at a point where the dollar once again is falling. And we're beginning to, at least year to date, see an improvement in international and performance improvement relative to the US markets. So that's everything that we need to discuss regarding the second quarter. We'll see what happens this quarter. There's going to be a lot of fireworks. There's a ton of government debt that needs to be refinanced. We should finally figure out what the total amount of tariffs will look like. And hopefully that gets kind of factored in terms of repricing. We'll see what that looks like as well. As always, if you guys have any questions on any of this or anything else, please reach out. You can reach us by telephone or via email. And as always, thank you so much. Have a wonderful summer, and we'll talk to you again at the end of the quarter. Take care.